Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Albert Einstein. Understanding finance and how it works might not be the most exciting thing for the average person. Talking algorithms, speculation, and the economy can be pretty boring at sometimes. However, one topic that can be very exciting is the one of compounding growth. Even Einstein knew that. Before we get into it, I want to look at simple interest or simple growth so we can better understand the more complicated form. Let's say you go to the bank, open a savings account, and deposit $10,000 into the account. Just like we pay interest on loans we take out for houses, cars, appliances, etc., the bank is borrowing our money and they're going to pay us interest for the ability to use it. So let's say the bank is paying us 1% interest. If you don't touch your money at the end of the first year, you'll have $10,100 in your account. 1% of $10,000 is $100, so you add it to your beginning balance. If you continue to not touch the money at all, at the end of year 2, you have $10,200 in your account, adding another 1% of $10,000 or $100 onto your balance. Sounds nice, right? But what if it could be compounded? Let's look at another example. We'll use the same scenario of depositing $10,000 into a savings account and the bank's paying us 1% interest. But this time the interest is compounded and not simple. This interest is commonly called interest on top of interest. So in the first scenario, after the end of year 2, we had $10,200 because of the 2 payments of 1% of $10,000, totaling $10,200. However, with compounded interest, the interest is calculated based on the new amount, not the beginning balance. So in scenario 2, we would have $10,201 in our account instead of $10,200 because the 1% of interest is calculated based on that $10,100 instead of the beginning balance of $10,000. So now you're looking at the difference between $10,201 and $10,200 and you're like, wow, one whopping dollar, what a huge difference. But remember, this is just a simple example paying a very low rate of 1%. There are other factors to consider as well. What if you were putting more money into the account over this time? What if you were getting a much larger rate of return? The compounding growth advantage could be much larger. The point of this conversation is to show the beauty of compounding growth. If you start to save earlier on in your life with a longer time horizon, you have the opportunity to possibly participate in long-term compounding growth with greater returns. If you have a proper financial plan in place, you may be able to execute a strategy to utilize your savings. If you don't want to listen to me, listen to Einstein. He knew a thing or two.